Even though research databases like CoStar and Yardi Matrix do come with a lot of helpful market data, these can be extremely expensive for individual investors and even small companies. But the good news is, even if you don't have access to these, a lot of big name brokerage firms like CBRE, Newmark, Cushman Wakefield, and similar companies have in-house research teams that publish free quarterly and annual market reports, which include a lot of really helpful information that can help an investor understand what's going on in a market. But since these reports can differ so much from company to company, and there's also a lot of information to take in within these, in this video, I want to walk through some of the most important metrics to focus on when researching a real estate market and why each of these things matter within an investment analysis. So the first thing you'll want to zoom in on when researching a real estate market can have a huge effect on occupancy levels, rents, and even values long term, and this is incoming supply. And in a market research report, the first piece of incoming supply data that you'll want to zoom in on is new supply that has recently been delivered in the market. And this typically involves looking at the total square footage of commercial space or the total number of multifamily units that were delivered in the last quarter or the last 12 months, and then comparing that to historical figures as far back as possible. Now, as you start to dig into these reports, you'll realize that by themselves, these numbers don't necessarily mean much, since it's hard to tell what something like 200,000 square feet of office space being delivered actually means for a market. And this is why one of the most helpful metrics to look at alongside this is new supply as a percentage of the existing inventory in the market, which can give you a much clearer idea of the impact that this new supply might have. For example, according to Q1 2024 data from CBRE, New York City led the nation in total multifamily deliveries by a pretty wide margin at 34,000 units over the last 4 quarters, but with these 34,000 units only representing 1.4% of the existing inventory in the city, New York actually saw rent growth in the market of 2.4% over the trailing 12 months. And this is in contrast to a city like Jacksonville, Florida, that saw what appears to be a much smaller 8,600 unit deliveries during that same period, but because this represented 7% of the existing inventory in this market, Jacksonville multifamily rents ended up dropping by 4.8% during the same period. And in addition to the new supply that's already been delivered, another metric to look for that's also going to have an impact is the amount of new product that's currently under construction and will likely be delivered in the next 12 to 24 months. Even if you're seeing strong occupancy levels and rent growth today, if the construction pipeline is significant and deliveries are expected to grow in the near future, this can often lead to an uptick in vacancy and rent growth flattening out or even turning negative. So this is also something to watch closely when you're reading through these reports. But with all of that said, an increase in new supply doesn't necessarily mean that a market is going to perform poorly, which is why it's also so important to track a market's projected demand in relation to that supply. And if we want to look at a current snapshot of this, one of the most helpful metrics to watch is a market's net absorption figures, which measures the change in occupied space over a specific period of time. When net absorption is positive, this indicates that more space was leased or occupied than was vacated or delivered in that period, which is a good indicator that demand is keeping up with or potentially exceeding new supply, while negative net absorption indicates that less space was leased than vacated or delivered, which can indicate the demand isn't as strong as new supply growth in the market. Most market reports will also include information on current and historical vacancy rates and also track recent commercial leasing activity, which can give you a good sense of the level of tenant demand for space compared to historical figures. And these reports will also sometimes include notable lease transactions that recently occurred in the market. Big companies signing big leases on office space or warehouse space, or big retailers signing big leases within shopping centers in an area is often a really good indicator that demand is strong. And when big companies make a bet on a market, this is also often an indicator that other companies are going to follow suit quickly. Some research reports will also track sublease availability, which can give you a really good sense of the number of tenants in an area looking to get out of their existing leases. And the higher this number is, the less demand for space there tends to be in an area. And from a demand driver perspective, one of the biggest indicators of continued expansion in a market is job growth, and many research reports will also include a breakdown of things that could directly impact job growth in an area, including manufacturing levels, retail sales, or just population growth in the last 3 to 12 months. Now, if the supply and demand story is compelling when researching a market, you'll also want to look into capital markets activity to get an idea of investor demand. Many market research reports will track average sale prices per unit or per square foot, which can give you a sense of where pricing is trending, and these may also include average cap rate data, which is often an indicator of how much growth the market is pricing in. In most cases, investors are willing to accept lower cap rates or going in NOI yields in markets where they believe NOI values are going to grow significantly over time, while investors will typically look for higher cap rates in markets where they believe NOI values will only grow slightly or even stay flat over the foreseeable future. These reports can also sometimes include notable sales activity, which can give you an idea of the interest in the market from major institutions. And since institutional capital flowing into an area usually means that there's a very strong buyer pool for properties in the market, this can also mean that your investment could be more liquid if you decide to enter the market and you ultimately wanted to sell. This is especially important when transaction activity is low, like we've seen over the last 2 years, when investors typically flock to larger gateway metros and shy away from deals located in secondary and tertiary markets. And this means that if you're not seeing much transaction activity in the metro or interest from investors overall, you could end up getting stuck with a property for longer than you'd like, and you also risk having a limited number of potential buyers that could get to your target pricing. Now, one thing worth noting is that every market research report is going to be structured a little bit differently, so it's worth looking through the research of multiple different firms to fill in the gaps that might not be tracked by one company or another, but ultimately what you're looking for in these reports are relatively low recent and incoming supply figures when compared to the existing inventory in the market, significant positive demand indicators, including positive net absorption, low sublease availability rates, a few notable lease transactions, and positive job growth indicators overall. And ideally, you'll want to see capital markets activity where big name investors are making a bet on the metro and cap rates and values are trending in a positive direction. Now, if you want to learn more about the real estate underwriting process and what to actually do with this market data that you might find in one of these reports, or how to work within a pre-built acquisition or development model to analyze a real estate investment opportunity, as always, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking a CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on the channel on market research techniques or resources available for free online, make sure to hit the like button and let me know in the comments which market research resources you use when analyzing deals. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.